Hello, this is Stacy Francis from Francis Financial. We are a fee-only wealth management and investing firm working with women and men, helping them find financial security both today and beyond. What we're going to be talking about today is the third market review as well as the election impact on the market. As you can imagine, it's a hot topic with everything that's going on in the world today. First, we're going to talk about the market review. We'll talk a little bit about the elections, look at the outlook going forward for your investments, and then also what portfolio adjustments that we are making to our client portfolios to essentially shore them up, make them more efficient, and better earners for our clients. And finally, we'll talk a little bit about that second opinion. So let's jump into the market review. Wow. All I can say is it has been quite a year, not only in politics, but it's also been quite a year in the market. We've seen a lot of ups and downs, but the great news is that overall, for the majority of the asset classes here, you can see most of them are up. In fact, if we look over here on the left side in our bond area, bonds have performed very nicely. Very nicely. In fact, the real exciting part, if we look at this, is that floating rate loans, a type of bond where the interest rate actually floats up when interest rates go up and down when interest rates go down, have done very well. In fact, we posted 7.7% return from this asset class just in the last 9 months. The other star performer is in the area of high yield. 15.3% return over the last 3 quarters. This is quite phenomenal, especially from a bond. We typically wouldn't really look to our bonds in our portfolio to be posting this high of a gain. Instead, we really look to them more as a buffer to the portfolio. But again, we'll be talking a little bit more about the role bonds have played both in the past and then also the role they're going to be playing in the future with our clients. Let's talk a little bit about stocks, and that's more so on the right hand of this chart. Stocks, too, nothing to complain there about. In fact, we see a star performer, particularly small U.S. company stocks, have done very well, a return of 11.5% over those last 9 months. And the other real nice star performer, emerging markets. We are somewhat overweighted to emerging markets, so this is an area that really definitely benefited our portfolios. We've seen returns of over 17% so far this year, and our clients definitely are happy about that. The one thing that definitely dominated the headline throughout the summer was the Brexit vote. Brexit and the market response to it really reminded investors that there are a lot of unexpected events and also unexpected market reactions. And in fact, this referendum that was in favor of leaving the EU took many people by surprise, including myself. And what was interesting is there was definitely a market sell-off. But what I want to show you is something even more surprising. After this market sell-off, where we saw in a 7-day period losses in the European market of over 13% losses here in the U.S., in the S&P 500, losses of over 5%, and even losses in emerging markets, what we saw is that sell-off was actually pretty short-lived, and we saw a dramatic recovery following. And this is essentially that story. After that post-Brexit return, those post-Brexit losses, we posted some phenomenal returns. In fact, over the last 3 months, we saw a 9% return in U.S. stocks. Here, you can see that 14% return in European stocks, essentially erasing any of the losses that we saw from Europe. And then finally, the exciting news of emerging markets, again, performing the way that we knew they could perform and giving us a lot of additional return, a lot of growth in our portfolios. So what has happened since then and throughout the year? With U.S. stocks, we have seen a pretty good year. The first quarter had more moderate gains. The fuel picked up in the second quarter. And then finally in the third quarter, U.S. stocks actually had their strongest quarter so far in 2016. That's great news for portfolios, but I have to say it also underscores our concern that U.S. stocks remain overvalued and actually are somewhat unattractive compared to some of the other asset class opportunities out there. The other opportunities such as investing in small company stocks and also investing in a more international portfolio. So what about an international portfolio? How have international stocks performed? Here we've looked at two different market segments. We looked at going all the way back to 2001 to emerging markets alone. And then below we looked at an even more diversified portfolio, emerging markets and developed international. Let me break this down. Your emerging markets are what we often call your BRIC countries: Brazil, Russia, India, China. Developed international includes Europe, Canada, essentially those more developed economies, including Japan, Australia, New Zealand. So together, here we have an even more diversified look at what happened internationally, going back essentially about 15 years. Over the last 15 years, no one will be surprised that come 2008, both of these markets dropped significantly. But what I think is surprising to see is that the recovery for both of these has been, well, tepid, to say the least. If you look at emerging markets too, quite tepid of a return. This is part of our reasoning, and in the research that we're looking at, is that emerging market stocks, the international market in general, is definitely has a lower valuation than we're seeing the U.S. stock market, essentially allowing more of an opportunity for them to rebound, more of an opportunity for them to outperform U.S. stocks. And that's actually what we've seen exactly since this last January. Now, one of the things we talked about in particular was that it is a little bit harder to make money in bonds than it has been in the past. Now, you may not feel that way when you saw those beautiful returns from floating rate loans, returns that were significant, 7.7% return as we talked about so far this year, and from high yields, 15.3% so far this year. But when we look at your plain vanilla, high-quality bonds like the U.S. Treasury yield, where our yield curve is today is unfortunately significantly less attractive than it was even a year ago. The Treasury yield, essentially, the bond yield, is the income an investor will earn from a bond. And where we are today and the type of income, the type of yield you can earn, you can see is a lot lower than the yields we saw even 1 year ago. Again, essentially making it more difficult. Here on the right, we're looking at a more historical perspective. We're looking at the treasuries of what were the yields back in 1991 and where are we today? Well, I think anyone, even someone who's not a mathematician, can get the story here, that there's been an ongoing march downward in yields, meaning that unfortunately it's much harder to earn money from treasuries of the same maturity and of the same credit quality. So what does that mean? Well, that means you have to be more diversified in how you think about your portfolio. You also need to be more diversified because volatility is picking up. In fact, we saw some of the highest volatility we have seen all year in the both September timeframe as well as in the summer during the Brexit issue. There are lots of reasons why we see this volatility, this up and down and large movements in the market happening. The first is the U.S. presidential election having a wild impact on the market. Concerns about the Fed rate hike, global central bank policy, and also the fact that the stock market is nearing an all-time high, causing a lot of individuals concern that it might be overvalued, as we also believe. So let's talk a little bit about the markets, about the presidential election and what you can expect from that. Well, there's no doubt that this is an election unlike any we've had in decades. It's offered plenty of surprises, but it's actually had a lot of surprises and impact on the market. And what does it mean for your financial picture? We went back and we looked at a total of several dozen presidential elections, going all the way back to 1928 with Hoover versus Smith. We looked at two factors. How did the stock market perform that year of the election? And number two, how did the stock market perform the year subsequent to that election, the year after the election? Well, what's really interesting about this chart is that if you had been worried that Democrats only are the ones that have positive returns, or Republicans only have positive returns right after the election, you would find out that based on evidence, that's actually not true. In fact, we can see here that Obama versus McCain was one of the years where we saw massive losses. Well, it was less based on the election. It was actually based on the fact that at this time we were dealing with the 2008 economic meltdown, as we all know as the Great Recession. The only other area where we saw massive negative returns is, interestingly enough, in the Great Depression during the 30s. So what we're seeing here is evidence, again, that it's less dependent on the candidate. It's actually more so dependent on the actual economic circumstances that are going on at that time. Let me show you this chart right here. I want to show you the different candidacies, Republican versus Democrat, and how the market performed. In this chart, we went all the way back to Calvin Coolidge, 1926, and we assumed that you invested $1 in the market. Well, I think we would all be happy because where that dollar would be valued now is well over $1,000, essentially doubling, tripling, quadrupling over time. But I think what's also important to know is that despite these presidents, whether some you may take issue with or not, all of them have had presidencies where overall the market has continued to trudge upwards, except for a couple little dips. And that right there is essentially what we, again, saw on the previous chart, the Great Depression. And the next largest dip we see here in the Great Recession of 2008. Again, these are more so based on economic circumstances, less so based on the presidential race. So needless to say, what we're trying to drive home here, a long story made longer, is that making investment decisions based on the outcome of what you think the presidential election is going to result in, unfortunately, is not very reliable. If anything, you can lead your portfolio into the ground by making rash judgments, going to cash, or making costly mistakes by selling a lot of your really high-quality stocks and moving them into safer bonds. There's definitely a strong case for investors to stay diversified, to have patience, and know that the markets go up and they go down, and they do that regardless of whether or not we have a Republican or a Democrat in power. This also just goes to say, again, staying invested. We looked all the way back to 1970. If you had invested in the S&P 500 for that time period and you invested $1,000, you would be walking away with almost $90,000 today. That return is a 10.27% return each year. Now look if we had just missed 15 of those best performance days from 1970 through last year. We would have posted only a 7.95% return. And what if you had decided not to even be in the stock market and instead wanted to be in very ultra-conservative T-bills and only that? here you would have had barely even a 5% return. Essentially, missing only a few days of strong returns will have a drastic impact on your overall performance. That's part of the reason why you want to stay invested. As far as the scary headlines in the news, trust me, I know. I almost fear putting the news on at night because you have all of these scary headlines. And we went back to take a look at some of those scary headlines to kind of give you a timetable, a time chart of when we saw the dot-com stock crash, the subprime mortgage crisis, the Eurozone debt crisis, U.S. home prices hitting bottom, fiscal cliff worries. What's interesting is this, again, shows the world index, so this includes U.S. and international stocks around the world, continue to march upwards. Continue to march upwards despite some very real and very scary international threats. So what I bring this to you is, again, trying to have that longer-term investment outlook and knowing that everything that's going on, our concerns about the international arena and some of the awful things that are happening, that you need to continue to stay invested because the market will be able to ride them out, and as a long-term investor, you will have much more financial security than those people who are not, because markets reward discipline. So what is our outlook? Well, our outlook is pretty good. Actually, right now, we're in the fourth longest U.S. expansion that we've ever had. You can see that we're almost up to a 90-month expansion since our lows that we saw in 2008. What's supporting this? Well, the labor market's definitely strengthening. We're seeing rising real wages. Household balance sheets are improving. Essentially, the massive debt that we saw, both credit card as well as mortgages, have been paid off. Very, very much a lot of discipline in paying those off. So the average consumer has more confidence. They have more confidence because they're earning more money. They're seeing their investments grow, and also they've paid off their debt, or at least a good majority of it. We're seeing also low inflation, so you can buy more with the dollars that you actually make, which is always nice, and also low energy prices, making your dollars go further so that instead of having to have all your dollars go towards oil prices or prices at the pump, we're seeing that you're able to use that for other things in your life. So that's all good news. Still, we expect international to outperform. I will tell you that this chart, there's a lot going on with it. And actually, if I was a PowerPoint expert, which I am not, I would say that there are a lot of things wrong with this chart. But what I can tell you is that it does tell a very important fact. And that fact is that on average, emerging markets have had price to earnings of 16.6. So this is their average valuation going all the way back to 1995 to date. And what's interesting is that where we see ourselves is that we're below this line. So essentially, emerging market stocks are priced below their average earnings. It's a fancy way of saying that they're actually pretty cheap. And it's also very good timing because this is also when we started to overweight our emerging market stocks, where we've seen this really nice rebound. We essentially were able to get in at a very good time. The other part of the market that we wanted to bring your attention to is U.S. stocks. Now, you've heard me say over a few times in this presentation that U.S. stocks are overvalued. Here we're showing you the historical price-to-earnings ratio, which is close to 18. And you can see here where we lie today. Essentially, significantly overvalued than our historical price-to-earnings ratio. Back to emerging markets, you can see that it's lower, that there's much more, they're much cheaper for emerging markets. And for U.S., much more expensive. Developed international stocks, you can see that developed international stocks has some really interesting long-term return potential, and actually we believe are also cheap compared to the U.S. This chart, again, showing us that there's a lot of good valuation in the European sector. And finally, the interest rates. Interest rates are definitely something that we take into consideration. We do believe that a Fed rate hike is more likely. In fact, when we look at the statistics out there and look at the interviews of those people in the know, according to the CME Group Fed Watch, they are saying 48% do not think that there will be a interest rate hike when the Fed next meets in mid-December. However, almost half of them, 42.6%, believe that there will be a hike by then. A small minority, but a small minority believes it could be even 2 hikes or 3 hikes. So although we are looking at the market and we know that the market has already priced in that the Fed will not raise rates in November, there is definitely some uncertainty that there could be a market shock if the Fed does raise rates in December. We really are concerned and want to make sure that our portfolios are well protected. And with part of that, I want to talk a little bit about some of those portfolio adjustments. Well, we're in the process of making some changes to our portfolio. Improvements specifically in the U.S. stock space where we don't expect a lot of return and we want to squeeze out as much growth as possible, and also the bond space, which we increasingly are concerned about and the impact of interest rate hikes on it. So let's talk about what we can control. We know that we can control a few things. Number one, being tax-efficient investors. In fact, investing in one mutual fund versus another can make a return difference of you up to 1% in any 1 year. And it's not, even if those 2 mutual funds invest in the same type of investments, you can still have a difference of a 1% return. Why is it? How is that? It's because if you have a manager that is buying and selling and turning over on a very frequent basis, you will find that you're going to have to pay, number one, more in fees, and number two, you're going to have to pay more also in taxes. So if you have the opportunity to control the amount you pay in taxes, if you have the opportunity to invest in the lowest cost way possible, specifically in really efficient parts of the market, like large company stocks, we believe that we can add significant value. In fact, let's talk about that. We are looking at our portfolios of reducing average cost expense ratios, essentially making our investments more efficient. We are looking at decreasing risk, particularly in our bond area. Right now, we want to shore up our bonds to be better protected as interest rates rise in the future. We want to use an evidence-based approach, which has shown long-term results, and we also want to increase the credit quality of our bonds. Our bonds have performed very well. We saw returns of 17%. We saw returns of nearly 12% in certain areas of our bonds. That has done very well for us in the past, but may not do as well as we come to a time where the market can only go so far in the U.S. And so it's a good time for us to kind of shore up our positions and make sure that we're ready for whatever the market throws towards us. This is our investment philosophy. It's a long-winded idea of what we do, but essentially it's long-term growth. That the best thing we can do for you is to create a portfolio that's right for your goals, for your level of risk tolerance, maximize the returns, and minimize the tax impact. We believe in being disciplined and as low cost as we possibly reasonably can. And with that, if you have any questions about your own portfolio, reach out to us for our second opinion service. The Wall Street Journal posted an article recently that 80% of successful individuals would appreciate a second opinion on their portfolio. We will do this for you to look at your personal situation, an analysis of all your holdings at no cost. We like to do this as an investment in you, but also it gives us wonderful insight into how others are investing and also what questions individual investors have, just like you. If you have questions whether or not you're on track to reach your goals, reach out to us. This is a fantastic service that there's no downside. Essentially, you'll walk away without having paid a penny, having a better view of where you are today, where you want to go, and all the steps you need to take between now and then to get there. I want to say a great big thank you. Please call us with your questions. I've got my phone number up there, 212-374-9008. And while I'd love to say I'm the only brilliant person on the face of the planet, guess what? I'm not. We have a fantastic team of analysts and professionals here that are doing research day in and day out, a fantastic research team at DFA as well as Littman Gregory. And any question you have, if we don't have the answer, because I will be honest, we don't have all the answers, we will get you the answer. So please do reach out. And I really appreciate you taking your time to listen in. And I also appreciate you for investing in your future, because I know talking about money, talking about finances and investing is not always the most pleasant thing to do. It's much easier to go out with a girlfriend and get a Cosmopolitan. But thank you for investing in you, because that's the most important investment of all. Thank you.